Welcome everyone to today's webcast. It's time to get serious about portfolio metrics and benchmarks. Today we're really going to look at how strategic PMOs can move from just focused on tactical project KPIs into defining and tracking metrics that really show the business impact of their function or PMO. My name is Ben Chamberlain. I'm the Chief Product and Marketing Officer here at UMT360, and I'm excited to present today's next installment in our strategic PMO series, where really we're posing the uber question of what are we managing? Are we managing projects, or are we in fact managing business investments? So before I jump in, just a housekeeping announcement. This is a moderated session today, so please use the Q&A manager throughout the session to pose questions. We will stop at the end of the session today to answer any questions that arise. So before we jump into today's content, just a reminder in terms of who we are at UMT360. At UMT360, we are seen as experts in enterprise portfolio management, really focusing on consulting and solutions in the better management of projects, programs, and portfolios at large. I'm the first to admit that enterprise portfolio management is an ambiguous subject at best, but the way we view the world is we're really helping organizations add often the critical and missing top-down business planning controls needed to transform the way you manage different portfolios. It could be the way you manage your projects and program portfolios, like the focus of today, or into managing other portfolios like application or IT asset portfolios, business capability portfolios, or product portfolios that are consuming scarce budgets and resources. Ultimately, we're looking to provide a framework that allows organizations to more effectively align all execution with the strategic priorities of their business. So in today's session, we're really going to take a look at maybe the perception problem that many PMOs face today, and then look at some metrics. And again, there's a laundry list of metrics that you can choose from. We're really going to focus on some more of the strategic-minded metrics today that may help your PMO demonstrate and highlight the true business impact that it is having. So let's jump in here. I think we have to ask ourselves, how is our PMO viewed by executives or by the business? Is it viewed as a value-generating function, or is it viewed as an important but yet tactical or administrative function? In one of their research notes from Gartner, PPM capabilities and solutions are not keeping up with the pace of digital transformation. Gartner say that by 2020, some 70% of IT project or program management offices will experience radical restructuring or reduction in numbers. I think there's a variety of reasons for that. I think the truth is that the way we identify, select, execute, or even measure projects is going to change over the next few years. But also we have to acknowledge the fact that the perception of the PMO may also play into this, if the PMO is seen as more of an administrative function versus a value-generating function. In another research note, establishing and fine-tuning effective PMO metrics, Gartner asked executives to share their perception of their PMOs within their organization. And on the chart on the right-hand side here, you see some of the responses. It was kind of split into sort of equal thirds here. The first was a kind of positive response, although it was a relatively unqualified response, is the PMO is an integral part of getting things done in my organization. But there's nothing really to substantiate what was meant by that. The next were kind of negative, the next two-thirds. The PMO is a useful administrative support function. Again, a tactical function, a kind of necessary evil for effective delivery of projects and programs. And the next, while the PMO has some value, they said, respondents also clarified or described the PMO as bureaucratic. So again, definitely seen more as an administrative function. In this research note, which was taken from the PMO Business Disconnect Prevents Risk and Opportunities for PMO Managers and Senior PPM Leaders, Gartner really looked to identify the perception gap between what executives thought the PMO should be doing and what the PMO was actually doing. Now, this survey was run across hundreds of PMOs, although I don't agree necessarily with all the findings here. This is what was flagged. So the chart on the right-hand side basically has been sorted by what the business or the executives viewed the PMO should be doing, and it's identifying some of the key gaps here. So status reporting for projects and programs. The majority of executives thought that's what it should be doing, and the blue bar here represents how many of the PMOs are actually doing that. Looking to monitor portfolios of projects and programs to ensure value is delivered. Delivering responsibility for projects and programs. Managing resources for those who lead projects. Tracking IT spending and projects and programs. I won't read them all here. You can glance down the list here to take a look at what the perception is of the PMO and what the PMO may or may not be doing. And I'll let you sort of cross-reference on this list yourself how much effort or focus your PMO places in any one of these areas. So the key findings of this report really was there's a disconnect between the project management office and its business customers. So this disconnect will emerge unless the PMO changes its activities to better align to the perception of these customers. PMOs are also missing the opportunities to develop and enhance business ties through support of strategy development and execution and ensuring the value of these investments or projects is being delivered. It also found that the PMO struggles through communication and effective reporting to gain a foothold in these busy executives' lives. So some of the recommendations coming out of this report was really to look at better understanding and aligning to the expectations of key executives or stakeholders, to actually take a more active role in helping to define, prioritize, and execute business strategy. And to take another look, and this is what we're going to look at today, in terms of relaunching the way the PMO reports and communicates its value back to the executive team. So for those of you that have followed many of our webcasts, this slide will definitely be familiar. So what we've seen is that traditional, and when we say traditional, more execution-orientated PPM is failing to deliver the anticipated results. Again, on the right-hand side here is a bunch of stats coming from different groups and analysts that show where some problems lie, whether it's Standish Group saying 18% of projects fail to get implemented, whether it's, again, Standish Group saying that 43% of projects fail or have cost overruns or schedule overruns, or what they call come in challenged. Gartner saying that 1 out of 3 completed projects experiences significant cost overruns. And even the PMI saying that 33% of projects don't meet their intended objectives. Our own research shows that these factors and other factors that we'll go into a little later today could be costing you around 46% of the planned business value or ROI from the investments in your project and program portfolio. Or another way to look at that is 46% of this investment may be at risk. As I say, we're going to drill a little bit more into some of the factors that results in that 46% in the subsequent slide. But I think one of the primary challenges here is that many PMOs responsible for governing projects have become or have remained too tactical in their outlook, taking responsibility for the management and execution of these important initiatives, looking after things like governance, schedule management, resource management, time reporting, reporting and dashboarding from an overarching visibility point of view, but simply are failing to see these projects as what they truly are, which are business investments. And if we buy into the fact that projects are business investments, investments designed to grow revenue, reduce costs, better align to compliance mandates, then we have to treat them as such and take strategic responsibility for optimizing spend, so having a level of capital stewardship, as well as maximizing value from this important portfolio. So looking at aspects like strategic alignment, looking at cost management, value realization, and also more business-focused metrics and benchmarks. So I'm the first to admit that the PMO has a daunting task. It's got to be comfortable in really mastering two roles. That's the kind of masters of execution, as the PMI or similar institutions may describe it, but also become more of the CFO and manage the business side of their projects and program portfolios. So with that, we'll pause for the first poll today. And the question here is, how well do you wear both the project delivery, so the master execution, and the CFO hats in your PMO today? So the options here on the poll: I'm confident with the project delivery role, I'm confident with the project and program CFO role, I'm confident in both roles, I'm not confident in either role. So how good is your PMO at wearing both hats, master's execution or being the sort of CFO or VC of your project and program portfolio? Another 5 seconds and we will close the poll and share the results. Okay, let's do that. So the results here, not too surprising. Majority, 57%, more of the traditional, what I term almost compliance-driven PMO, taking greater responsibility for project delivery and project execution. Fewer, only 5%, maybe more of this newfound enterprise PMO now that really is responsible more for the business side or wearing the CFO hat. I'm happy to see, close to 20% are confident in both roles, and again, unfortunately, 19 or 20% are not confident in either. But that's a good trend. So let's get back to the deck. So next, we're going to sort of dive into portfolio benchmarks and metrics. I think it's an overused term, but the quote here, if you can't measure it, you can't manage it, I think is apt for this situation. Now, what I think we have found over the years is PPM, or project and portfolio management tools, have become a de facto system of record, going beyond just maintaining information around resources and schedule, but also starting to pull in other information, strategy information, financial, both cost and benefit, governance information, risk information. But I'm not convinced that these PPM tools, even with the advent of big data and business intelligence, aren't really holding this information hostage. How effective are we as a PMO at mining this information and surfacing this information back to the business to show the impact that we are having on the business beyond the impact of project governance and effective project delivery? I think what we have to do here is go beyond the physical management of KPIs and metrics that the business expects us. So whether that's looking at overall health of initiatives or work performance, schedule performance, cost performance, risk. Now, going beyond these traditional project level KPIs that people expect when we're focused on project execution and project delivery, into actually looking at metrics that demonstrate the business value. Now, there's many metrics that we can surface here. It could be tens, maybe even hundreds of metrics that you can choose from. The idea today is really to focus more on some of the strategic and financial metrics that can show the business impact. Metrics you may be able to group into areas like strategy, cost performance at the portfolio level, benefit performance, governance, risk, schedule, and other areas. So what do we need to do to define the right metrics and benchmarks. Like I said, quite honestly, there are many, many, many metrics that you can choose from. And today is not going to be a simple overview of everything. But what we want to really position here is let's not go crazy up front. Let's look to identify some of the key challenges that we see our business focus on or face, and then look to define metrics that help us communicate how we're impacting that specific pain or challenge. So don't boil the ocean. Start with a few metrics that you know are top of mind for the business or the executives in your organization. Goes without saying, having defined the metrics, let's look at making sure they're automated. Off the data set, define the relevant formulas and thresholds for those metrics. We want to also set targets and goals. It's important to baseline up front on these metrics and then look to set goals in terms of the changes that we want to make in relation to this metric. And then last but by no means least, let's continuously track and communicate our impact on these metrics, whether that's month over month, quarter over quarter, year over year. Let's show the steady progress the PMO has in improving this metric, which again is affiliated to a key pain in the organization. So I'm going to go back to this 46% number. Now, of course, this isn't going to be definitive in terms of all the pains that an organization faces. But here's an example of some of the pains your organization may be facing. When we think about that 46% number, the 46% of lost business value from maybe adopting more of a traditional execution-oriented PPM discipline, what are the sort of key factors that are contributing to that loss in business value? So factors here around inefficiency, unreliable planning, poor financial insight, resource utilization, inadequate benefit management and metrics, and even disconnected portfolios. I'll go into some of these in a little bit more detail. I think one of the overarching challenges is disconnected information systems and too many manual processes. So as a PMO, we tend to find ourselves spending too much time manually reconciling information and building reports, taking away from our ability to have information at our fingertips and then make quicker decisions to affect change. So that's an area definitely want to focus on. Unreliable planning. Again, we got full webcasts on this subject of how to really adopt stronger top-down driven planning approaches that ultimately generate the right project demand, program and project demand in the first place. Often poor planning techniques can result in suboptimal portfolios, which simply means you're not identifying the right initiatives and you're leaving business value on the table. Another problem with planning is often organizations adopt more of a what we call a set it and forget it approach, which is often common in annual planning. Projects are selected, you sort of then pin your ears back and execute on those projects throughout the year without accepting the fact that variables will change and you'll need to take corrective action throughout the year to optimize spend and maximize value from that portfolio. So definitely areas around strategic planning and more like dynamic planning are areas that we can build metrics around. Lack of financial insight. When you think about the inaccuracies of cost and benefit estimates, it does hit you from a value point of view. Early on in a planning cycle, if cost estimates are too high, for example, you're often going to optimize a portfolio under different budget constraints, draw the line too early, and leave too many good projects behind. Without a technique to revisit those decisions throughout the year, that value will be lost. By the same self-token, if my project estimates are too low and my project costs start to slip during the year, I'm still going to have to recorrect and take action on that portfolio. Budget utilization is another concern where often organizations don't spend all the available budget in a given year, again, leaving value on the table. We'll look more at things like this. Resource utilization, simply the ability to understand who's available to work on what projects. Resource shortfalls can result in projects getting delayed or not kicked off. Again, that's going to hit you in the back pocket from a value obtainment perspective. When we look at things like benefits management, the ability not to have portfolios, the right portfolio metrics and benchmarks is important. The inability to actually measure and track benefits realized is another area of concern. So these are just examples of some, not all, areas of pains that your organization may be focusing as it relates to the PPM process and that potential loss of business value. So let's jump into the metric portion. Like I said, there's many metrics we're not going to cover today. A lot of the sort of operational performance metrics I'm not going to touch on. We're going to look at some examples of metrics that maybe relate back to some of those challenges that we just looked at. The first is, maybe let's start with the basics. Now, when working with customers, we often look to baseline around some pretty basic areas, whether that's cost overruns, schedule overruns. You know, going back to those Gartner and Standish metrics I shared some moments ago, or failure to implement. How many projects did you fail to implement during the year? Or challenge rates. You know, how many projects did have cost and schedule overruns? Or even, let's not forget, the success rates. How successful were we delivering projects on time and within budget? So these are what I consider some of the basic metrics that we should all be looking to track, and often we'll look to baseline with a customer when we start working with them, simply so we can track year-over-year improvement in these certain areas. So to the next poll. So what I just want to check now is, on these metrics of cost overruns, schedule overrun, failure rates, challenge rates, are you able to report on these metrics today in your organization? Do you have insight that gives you a gut feel where you are year over year based on these metrics? So let's go to the poll. So is your PMO able to report on these metrics? So cost and schedule overruns, failure to implement, challenge rates, and of course the important success rates. Yes, mostly. Not so much, not at all. So another 15 seconds or so, and then we'll shut the poll. So what's our ability to report on these core metrics? Let's shut the poll and see the results. So 8%, yes, absolutely. So another 29%, so around 37% of us or so that are able to track these metrics, or mostly track on these metrics. 55% of us say not so much. Now that could mean that you're able to focus on cost overruns, schedule overruns, but not the others. And 8% of us not at all. So my bet is that even if you're in an early stage of maturity in terms of your PMO, you have the ability at the highest level to look at things like cost overruns, potential schedule overruns, and then generate these metrics. So this may be an example where you have the information under the hood, but you're just not surfacing it and really showing some of the sort of basics in terms of how a PMO is improving overall sort of project delivery and execution. So let's move on to the slides. So I'm going to pick a few more metrics here in no particular order. We branded this metric under sort of governance. It could easily also be under the sort of schedule metrics area of time to market or velocity through the process. So why is this important? Well, for many organizations, or for nearly all organizations on the business side, agility and time to market is key. The ability to release net new products, services to market quicker, realize the benefits from those investments quicker is certainly important. From a sort of internal perspective, being able to identify key bottlenecks within the process, within the workflow, and look at streamlining so these investments can move through quicker through the governance workflow is also key. So you have the ability with time to market or velocity metrics to really take a look at identifying how long projects remain in key stages of your overall workflow. So in this example, we have an end-to-end workflow: create, select, plan, manage the overall phases here. Create and select represent what we consider to be the planning velocity. So how do we go quickly, do we go through that kind of annual planning process into detailed planning and ultimately into execution? So you can track planning velocity through these first few stages. Delivery velocity may well pick up in the manage phase in terms of how quickly we were able to get through the execution portion of the project's life. Now, of course, this metric, when averaged out across all different types of projects, maybe loses a little bit of meaning. But if you're looking at the same type of project, a new product development project, other similar projects, then it's more meaningful. The next metric, which is also interesting, is around sort of bottlenecks, the review velocity. How long are these investments or projects sitting in these approval gates, ultimately before they're approved and moved on? So again, the ability here to really look at understanding how long projects stay in key stages in our governance workflow, and then looking at understanding velocity, again, is a good metric to report on. Let's maybe move on to the next one, budget utilization. We mentioned budget utilization up front in terms of one of the key challenges. So why is it important? Now, we often find with many organizations that they fail for a variety of reasons to utilize all the top-down budget available in a given year. And again, there's different reasons for this. Could be projects that slip from one year to the next year, unplanned carryovers. It could be resource shortfalls or other things that stop you kicking off projects as you intended throughout the year. But one of the primary factors for this is actually poor forecasting, with project managers often holding on to budget until too late in the year before realizing they're not going to be able to utilize it within that fiscal period. And of course, that budget gets lost and no value is generated within that particular period. So budget utilization is a key metric, because if you're not utilizing the budget in that year, you're not maximizing the value you can get from that portfolio. So being able to track the budget utilization year over year is important. Pretty simple metric. We're looking at the total actual spend in the portfolio divided by the top-down allocated budget for that portfolio. And again, you can look at tracking your better utilization of that money throughout the year. And here you see a chart that shows sort of year-over-year improvement based on allocated budget, top-down budget versus actual spend. Now, the next one is strategic yield. Now, often when I'm speaking to customers about budget utilization, they say, I don't have a budget utilization problem. I spend all my available budget. The next question is, how effectively are you spending that money, right? Because you need to spend the money. You can buy a bunch of vendor solutions in Q4 when you realize that money is still up for grabs. But how effective were we in spending that money? And this is where strategic yield comes in. If you followed our presentations before, you'll know that we're a believer in this particular metric, yield. And how yield is calculated is based on the strategic value, so doing an impact assessment of how your project will contribute or impact the core strategy that's been defined and prioritized in the business, and that derives an absolute strategic value score, divided by costs, whether it's the cost estimates at the early stage in the project life, whether it's the cost forecast. And that gives you a yield score. Now, value and cost can change throughout the life of the project. Cost definitely, value should too, but not many people update their benefit estimates. So yield in itself is a dynamic metric, and it's used in a whole host of ways, whether it's the project level in sort of annual planning to understand the bang for the buck of each investment, value over cost, whether it's used in the ability to more effectively assess planned projects with in-flight projects, because yield is an investment viability indicator that spans the entire life of the project, not just used for annual planning, but also used in in-flight analysis of projects too. But here we're talking more about portfolio level metrics. So yield actually can also be aggregated to the portfolio level. So it gives you some indication in terms of when you're starting the year, what's the planned yield I'm expecting from this portfolio, which gives me the ability then to look at variance, whether that's planned versus forecast yield, to give me my strategic variance. I can also look at realized yield. Once I start to complete projects, how much of the planned yield am I realizing? as you see here. I can even go down to metrics at the project level again, which is showing, okay, across this portfolio, what is the average yield across the projects that are being generated? Again, looking at that value cost ratio. It is an important metric, one that we've used commonly, or many organizations have used at the project level, but at the portfolio level, it's going to help you also look at how effectively you're spending your money. Now, for those of you that have seen our webcast on dynamic planning, you'll know the importance of dynamic planning, moving from that sort of annual planning, set it and forget it approach into more of a dynamic framework where you're rebalancing the portfolio throughout the year to optimize spend and maximize value from the portfolio. So again, you'll see how these metrics come together to support that dynamic planning process. Because again, we want to assess budget utilization throughout the year. This is actually now going to look at the total or the forecasted spend from the portfolio divided by the top-down allocated budgets to understand, are we better utilizing all the funds within this planning period or within this execution period. But of course, again, we want to look at effectiveness. So not just looking at budget utilization, but looking side by side in terms of the impact on yield and the yield variance. How much of the variance were planned versus the forecasted yield we're getting from this portfolio. So am I using all the money? Am I using all the money as effectively as I could be? Is how these metrics sort of kind of come together. Another metric we start to see the PMO using is actually around budget churn. When you think about a dynamic reallocation process, really it is a discipline of saying, look, these projects don't need all this money. You know, the forecast costs are less than the original plan. So throughout that year, we want to quickly release funds from those projects and then make a decision whether to fund existing projects more, projects that require incremental funds where forecast is greater than plan, or make the decision to actually bring net new projects in from the pipeline to optimize spend and maximize value. So budget churn is actually an interesting metric where the PMO, let's say on a quarterly, a monthly, quarterly, or annual basis, can actually look at how did they impact the reallocation of funds across the portfolio. Now, how much money was released from existing projects, and how much was then redirected relative to the total budget, and looks to the churn number. Again, I would argue that churn on its own is strong, but you have to balance that with strategic yield as well, because it's easy to move money around. It's less easy to prove that that movement had a positive impact from a yield or a value point of view. So investment alignment deviation. I think what we've been looking to do for years is look at ways of more objectively understanding how well is my investment in the organization aligning with the strategic priorities of my organization. So again, by following that more structured approach that I alluded to earlier in terms of strategic value definition at the project level, where basically I have the ability to define and prioritize a set of business drivers. So I engage the executive team to understand what the relative priorities of the business strategy is. And this is important. Now, we don't want to simply rank 7 business drivers 1 to 7 in kind of a stack rank. We actually want to understand their relative importance. So top business driver has 33% of the weighting, bottom business driver has 3% of the weighting. Why that is important is because I get to understand 2 things. I get to understand the relative importance. So the example I just gave, the top business driver with 33% of the weighting is approximately 11 times more important than the bottom business driver with 3% of the weighting. But I can also use this relative or normalized score to assess investment alignment. Because if I had $100 to invest in my strategy and I wanted to ensure total alignment, I'd stick $33 on the top business driver and $3 on the bottom business driver. By taking a more objective approach to understanding a project or investment's contribution to strategy, by mapping it into 1 or more business drivers, in turn we can look to aggregate financial information and express it proportionally to or relatively to the business driver priorities. So the investment alignment deviation here is really looking at how far we're off the perfect alignment. So perfect alignment would be cost, the cost, allocated cost equals sort of driver priority here. But obviously, that's not how things work out. So how far are we away from having a perfectly aligned portfolio? And we can look over time at looking to improve the quality of the demand generated before we even look at portfolio selection techniques to ensure that the projects teed up in the demand management process or even the in-flight portfolio is optimally aligned from an investment perspective with our strategic priorities. But again, needs a structured process to be able to derive these views. So I kind of warned you up front, we'll be jumping from different metrics to different metrics here. Again, this isn't a definitive list. This is just an example of some metrics you may want to consider to look at moving away from those project level KPIs into more business impact driven metrics. The next one is forecasting accuracy. So why is this important? Well, this goes back a little bit to budget utilization. We want to get a lot better at predicting where we're going to end up at the end of the year, what our actual costs of this portfolio will be. I think the natural tendency is for project managers and people managing projects to, from Q3 and Q4 to ramp up their forecasts as they look to catch up. The current spend rate is actuals less than plan, and then they forecast they're going to catch up by the end of the year, often holding that money hostage. And the truth is you see a natural spike of the forecast in Q3 or Q4, but the truth is they never really get there, right? So how can we as a PMO start to leverage information in the system to predict what the actual cost of this portfolio will be, even as we're sort of entering H2 in the year? The truth is we hear a lot about predictive metrics. How can we more effectively predict where we're going to end up? But from my experience, almost the best way to predict the future is to better understand the past, right? So we can start to leverage empirical, historic information to show how things are going to trend. In this exact example here, we can see the forecast line here, which is showing we're going to spend $191 million by the end of the year. But the bottom line here is actually showing an average of 2-year spend patterns before. And you often see this. In the current year, the project managers are saying, look, there's going to be a spike in Q3, Q4 from a spend perspective. But if you look at what they did in the last few years, you often just see a linear spend pattern. So once you have this information, as a PMO, you can start to actually predict with a level of accuracy where you're going to end up. So in this example, we're actually predicting, we're going to be around 182 million versus 191. So we can actually now start to track over time our forecasting accuracy. How far were we off the actual end result? One CFO once told me there's no such thing as a good surprise. If you come in over, if you come in under, they're about as bad as one another, right? So let's get better at actually predicting where we're going to end up. And again, leveraging historical information will allow you to get very accurate in terms of predicting the future. In this case, predicting where the actual cost of the portfolio will end up in December. So next, run, go, transform ratios. Obviously the importance here, especially in budget-constrained worlds, is to start to look at documenting what is considered run costs or mandatory costs to a degree within the organization versus what is considered truly discretionary, grow and transform. And then to look at techniques, and this goes beyond the context of this presentation, but at least look at techniques to rationalize and optimize the run expenditure so that we can free up more funds to ultimately grow and transform the business. Obviously, being able to structure this run, grow, transform mix is an important discipline in itself, whether you're just doing it across your project investments or whether you're casting the net out broader across all operational activities, let's say within IT, as well as the discretionary activities. But simply being able to document where you are from a run, grow, transform perspective, and then set up these goals and targets to show how you want to impact those ratios going forward, again, is important. And there will be a number of projects and other investments you'll need to make to positively impact the reduction in run to more effectively fund growth and transformational initiatives. So the metrics themselves are pretty simple. We're just looking at investments that are teed up as the running investment divided by the total investment or available budget, and the same for grow and transform. Next, estimating accuracy. We talked already about the impact of poor estimates. Now this is focused on cost. The same holds true for benefits. The same holds true for resource estimates too, to a degree. But in this estimating accuracy, we basically have the ability to understand, either at the project level or at the portfolio level, who is good at estimating. So this view here, for example, is actually showing the average estimating accuracy or budget deviation by departments. So you start to see which departments are sort of above the 100%, which would be, you know, their actuals were exactly as they planned. So above 100% would be you know, they're over budget, below the 100% line here, where they're coming in under budget. So we can start to see high performers and low performers from a departmental or portfolio level perspective from an estimating or budgetary perspective. And then you can drill down within a department to look at how that metric was derived. So look at the different projects and the estimating accuracy of those projects. Why this is important is we can start to hedge this into our planning process to a degree. If we know that an organization is always estimating over budget, you can hedge that into the planning process. Maybe you're going to bring more projects through in the upfront planning process because you know they're not going to spend all the available money. You can also look at more fairer allocation of funds based on you know, past performance from an estimating point of view. So estimating accuracy, another key metric. Now, you can look at that from a total project cost perspective, but you can also start to look at that from how strong our estimates are at different common stages in the governance workflow. So in this case, we're able to look at snapshotting the estimates at, say, gate 2 here, which is the select gate. And any project that passes through this gate is going to get a snapshot, and the core metrics and estimates of that project going to be recorded. And then you can compare that when the project's completed with the total completed cost and look at, for that project, how accurate were the estimates at this gate 2, select gate, and do the same again in the next gate, the plan gate. The benefit here is we can start to see with some certainty as we evolve the project's level of detail from a planning perspective, how the estimates improve. And we can start to use this information to really highlight areas of concern and look at working with project managers in terms of improving estimating accuracy at any one point. So again, we can look at estimating accuracy at the highest level from the project, or even drilling down, snapshotting, and understanding how estimates improve at different gates in the funding process within the project. So first gate here could be plus or minus 37%, second gate here plus or minus 15%. So resource utilization. Of course, resource management remains key. We want to effectively utilize the precious resources within our organization. So looking at metrics like overall resource utilization, which is looking at all committed resource assignments divided by the total available capacity, is a good metric. Whether you're looking at that across all resources or even drilling down by fundamental roles or skills like developer, analyst, tester, whatever they may be, project manager, to understand the resource utilization of those skills is important too. There are a whole variety of metrics that we could drill into from a resource management perspective. Another one that I've seen organizations utilizing is things like project manager oversight, where actually you're looking to understand and control how much project management hours are dedicated to different projects. So you can actually look at setting goals and targets that say, let's say, I only want 10% of the total working hours for a project to actually come from project manager. So looking at the project manager total working hours per project divided by the total work for that project and figuring out, is that within that threshold. And of course, you can do that for any of these resources, project manager, analysts, or whichever resources you choose. Another area we see organizations focusing is in terms of resource mix. What's the perfect balance of internal resources versus contract resources versus consultants, or even offshore, if you can break this down further within the organization. Again, a relatively simple metric, assuming that you have your resource pool defined correctly, and you can classify the difference between a full-time versus a contract consultant or even offshore. But looking at the right resource mix, resource ratios, looking to change that over time is another area. So another one of the factors we looked at was inability to track benefits. And I have a slide here just to lead into this because it's kind of a pet peeve of mine. So I'm kind of looking forward here into kind of the key trends we're seeing and seeing more and more organizations look to start to track benefits in 2016 and beyond. Now, as I say, it's a pet peeve of mine. I think for far too long we've been using the business case of a project really as just a funding vehicle. So you tee up benefit estimates within that business case to substantiate that investment, and then file that business case, within a document repository or a desk drawer, never to see the light of day again. So, why does benefits realization remain so elusive for us? And what are the steps you may want to consider? And we're planning to do a webcast on this in more detail around benefits realization. So the first thing is we've got to treat benefits, much like we treat other financial structures like cost. So let's first and foremost standardize the financial and non-financial benefit structures that we expect to be documented for an investment to be evaluated. So again, both the financial and non-financial. I guess another area is accountability. Now, it's not normally the project manager that comes up with the benefit estimates for an initiative. It is the stakeholder. It's the person that teed up that investment in the first place. So we've got to start to drive more accountability. We have to make it clear that there will be a look-back framework where we're actually going to start to evaluate benefit performance the same way that we evaluate cost performance. And potentially folks will be held accountable for not realizing the benefits. But accountability is a key driver in terms of helping to improve estimating accuracy of benefits. The next area is actually, much like cost, to realize that as we get deeper and deeper and deeper into the project's life cycle, that the benefit estimates should evolve too. As we had a clearer picture in terms of what this project is going to deliver, we can evolve our benefit estimates versus just keeping them static within the initial project business case. Also, you need to be able to track benefits at the right level. I think one of the key problems around benefits realization has been tracking benefits at that project level versus an aggregate level, like an investment program, or let's say you have a project that's going to reduce the cost of an IT asset, like an application. Actually, tracking the resulting benefit back at that asset level versus the project level. And the last but by no means least, and this goes back to almost the topic of today, let's publish and make these results visible, both the high performers and the low performers, from a benefits realization perspective. So, poll here, just out of interest, is your PMO tracking actual benefits realized by projects today? So is your PMO actually tracking benefits? Yes, across all projects. Yes, across some. We plan to track the benefits realized, or we don't, or we're unable at this stage to track benefits. So yes, across all projects. Yes, we kind of do a sort of look-back process, a random selection across some projects. We plan to, or we don't, or unable to at this stage. Another 5 seconds, and we'll close the poll. So at first glance, I'd say this is very positive. So, 3% yes across all projects, 24% across some, with 27% saying we plan to track benefits. So that's a lot higher than I normally see when polling folks in webinars and also live presentations. So the trend is good, and hopefully in 2016 and beyond we'll convert more of these 46% of you that say we're unable to track benefits or don't track benefits today, because I think everyone is able to. It really starts with let's substantiate the benefits as part of the business case, and then look at the right techniques to track benefits at the right level so it doesn't become too onerous for the PMO and finance team. So back to the slides. I'm going to wrap up here in the next 7 minutes or so. So example benefit metrics. Benefits realized, pretty basic one. Actual benefits at the portfolio level or the project level divided by the planned benefits. Obviously, we're tracking these benefits beyond the traditional life of the project investment. Benefit variance. So planned benefits less forecasted benefits, or this could easily be actual benefits divided by costs. Another area is looking at things like payback period, right? We often generate things like payback metrics. Number of months we think we're going to break even on these investments. So let's go back and see what is the actual payback period. Again, it's another example of a metric that may not make sense ubiquitously across all projects in the portfolio, and you may want to be doing that more on a like-for-like assessment of the same types of projects. That's more of what I consider to be the sort of traditional benefits metrics. But I think there's also some softer benefits metrics that you may want to consider. And when we close out projects, many PMOs today are looking to structure and document lessons learned, so that can feed into the overall improvement of the governance process. So we can start to use survey mechanisms to collate and score success, whether that's from a lessons learned, an example on the left-hand side here in the screenshot, where we're looking at how well things went, and then deriving a score in terms of how well the project was delivered from multiple dimensions, and then averaging that out at the portfolio level. Or even if that is, let's say, for an IT project, or even a business project, polling the end user or customer in terms of their satisfaction around the project and the deliverable, and looking to average that out and trend those scores quarter over quarter, more importantly probably year over year. So again, it's not just about the traditional financial metrics, which we certainly want to start tracking. There are other metrics that we can start tracking today around lessons learned and overall satisfaction, customer satisfaction in terms of the deliverable. And my bet is out of that 46% of you that weren't tracking benefits today, I think many of you may actually be looking at documenting lessons learned today. So that may be an easy way to start to look at more objectively deriving scores that can indicate improvements across the board from how a project was executed and then the resulting deliverable through the average customer satisfaction. So key takeaways, very similar to what I spoke about earlier. I think this goes back to the overarching theme of what we're looking to do here at UMT360, which is provide the traditional PMO or the new age of an enterprise PMO with the tools needed, the top-down business planning controls needed to really treat projects as business investments and start reporting back in a business manner to, in turn, show the business impact that your PMO is having. I think we need to continue to do a good job of wearing the project delivery hat and looking at reporting on the regular KPIs. But we've got to quickly graduate beyond that, identify the key, what we consider to be the key challenges or pains in the organization, and start to demonstrate how the PMO, how the PPM function, how the PPM community is having a positive impact in those areas that are top of mind for the executive team. Now, of course, we touched on a few metrics today, and the list is long. It really is you can be a kid in the candy store selecting how many metrics you want, but let's not go crazy. Let's start by identifying those key metrics. Let's start by showing positive improvement, and let's start also by are using that to help change that perception gap that may exist between the executives, the business, and your PMO. Again, tracking is important, and communicating effectively is important. So identifying the metrics, one thing. Baselining those metrics is certainly key. And then finding the right cadence, depending on the metric, to communicate that regularly. But also then look to refine that metric over time. Look to refine that portfolio of metrics you bring on as you progress through your PMO maturity journey or your PPM maturity journey. So in regards to that, there's many ways you can engage with UMT360. One of the things we look to do here is provide both solutions, products, whether it's our implementation of tools like Microsoft Project Online, Project Server, or UMT360, a solution that seamlessly extends that environment. But we really look to provide the solutions and services that are going to support your PMO on your entire PPM maturity journey, whether that is in visibility, really establishing that foundation to get visibility across all projects, investments. Next, whether it's actually moving into insights, where we're providing additional strategic and financial insights needed to treat projects as business investments, take more strategic and timely action to optimize spend and maximize value across these portfolios. Or even if it's getting broader enterprise context. Now, quite honestly, projects and programs don't exist in a vacuum, right? They're funded to impact something else in the organization, onboard a product, enhance an application, change a business process or capability. As a PMO, and as with the advent of business digitalization, we will start to look across all portfolios in the organization to get a good understanding or complete understanding of our complete enterprise, of the operating fabric of our business, and be able to then start to apply portfolio management and portfolio techniques to managing other portfolios, be that product portfolios, service portfolios, IT asset portfolios. So again, solutions we provide, the consulting services we provide, will support you at any stage on the continuum. So reach out to UMT360 and see how to get started, whether that's a simple envisioning exercise where we'll actually sit down with you, understand where you may be in terms of that PPM or PMO maturity journey, visibility, insights, and into enterprise context, and can actually help you define roadmaps to improve core capabilities, to master project and program management, and ultimately then master enterprise investment management across all portfolios in your organization. So with that in mind, we're on the top of the hour. I will pause for any questions that arise, but if you have to drop off, I want to thank you for your time today, and please look out for the next webinar from 360.